Options traders have a tendency to get very panicky about markets, and there's plenty always to get panicky about. But we're going to talk about ways to be bullish when options are cheap today on open interest. Hello everybody and welcome. I'm Mike Can. Welcome to Open Mic. Hope you all had a good weekend. It's pretty common for options traders to think a little bit about hedging. There's more than one way to hedge though. Usually the way people think about hedging is they think about buying puts either on the stocks that they hold or in many cases when index volatility is cheap, as I think it is right now relatively, to buy some downside puts or put spreads, usually put spreads. And the reason for that is that I often talk about implied correlation. That's the relationship between index options and the price of options on single stocks. The thing is that while that's generally true at a very high level, and what I mean by that is that you can compare the at-the-money implied volatility for the S&P to its constituents, and generally you use just the top 50 constituents because it's going to be those stocks predominate just by virtue of their market capitalization. The skew in index is generally steeper, and what that means is that out-of-the-money puts on index are considerably more expensive relative to those at the money than would be the case in the single stock options. I think I showed this chart a week ago or so. I'll do it again just for an example here, and then we can think about what the implications are and how one can think about playing this. So we'll look at the skew now in the S&P. We could do the NASDAQ too, I suppose. I'm going to just go out 1 month for now. So we'll use 1 month because that's sort of the convention. We'll do the same thing for NASDAQ. Go out 1 month, and I have to adjust that to today. So we'll do today. And let's pick, now this will be kind of interesting. I'm going to choose NVDA here because NVDA reports this week. And so it has a potential catalyst, and that can have important implications, and I must have put that in NVIDIA. There we go. So we'll take a look at NVIDIA here. Again today, very flat volatility there, and perhaps we'll take another big constituent. Let's pick something else from in here to look at. So we looked at NVIDIA already. Actually, I should do it this way. I want to do it by weight. And I don't subscribe to the weights for the indices, but I can back into it from this. Oh, what the heck. We'll just choose, let's choose Amazon. Why not? So we'll put Amazon in here too. And look at the same thing. So what are we looking at and what are we looking for? And really what we're looking for here is the relationship between the prices of options on these big constituents of the index. And you know what? Oh, that stinks. My Zoom it thing is not working. Okay, so what we're looking for here is the relationship between the prices of stocks on the options on the single stocks and the index, and comparing how that changes between at-the-money options, so the 100% moneyness here, and the out-of-the-money options. Call it the 90% of the money. And what you can see is that the spread is much wider between the implied volatilities of single stocks at the money and just out of the money than it is if you go out of the money to the downside. So on the upside, there's a wide spread up here around 105% money in this. That looks like it's actually pretty much the peak in terms of the difference between them. And so if you're thinking about what a good outcome from NVIDIA might mean. So if we take a look at NVIDIA, one of the things you're going to see is that these moves have been pretty much ho-hum for the last 4 reported quarters. You're going to notice that actually the stock, 1 month after each of the last 4 reported quarters, has actually been lower, on average by almost 6%. And given the weight of NVIDIA on the index, so it is about 8% of the S&P, closer to 9, I would say, for the NASDAQ. What that means is that, on average, over the last 4 quarters, given its weight, if we were to sort of think about what the impact would be this time, that would create about a 50 basis point drag on the S&P or the NASDAQ index. And, we'll find out. Maybe this will be the result that reignites the fire, the love for NVIDIA. I mean, there could be reasons to love it, one could say, not least of which is that if you take a look at its forward multiple, even assuming it didn't grow much thereafter, it's quite cheap. So as of today's price, let's just round it up and call it $2.10, and we'll round down next year's adjusted EPS to $13. We'll round the share price up to $2.10, and next year's anticipated adjusted EPS that gets us down to about 16 times forward earnings. So even if it simply grew at the rate of the economy, that's not a bad multiple. So it's pricing in as if the news could be fairly negative. And from my perspective, when people start getting a little bit negative on things, maybe it's a decent time to think about looking in the other direction. And from my perspective, if the news is good, that's a 50, let's say they got a comparable move to the upside. So you can see that technically it's all looking a little bit grim for NVIDIA here. Let's say they got a 6% move to the upside. That's 50 basis points in the S&P over the course of the next month or so. We are seeing some rotation into other sectors, so they could continue to present a little bit of a tailwind. We are coming into a higher volatility period. And just looking at these skews, I can't help but think that probably the best way to make a bullish bet is not to buy calls in these stocks, but rather maybe just to buy the calls in SPY or something like that. You don't have to risk a lot to get a little bit of bang for your buck here. And let me show you what I mean. So we'll pull up Options Play and take a peek. And see what we're looking at. I did happen to write an article about this, which I think was published today on the CNBC website, but I don't know that it matters much because the market is a little bit lower today. So even had you put this on, you're probably going to get an opportunity to get in at a better price even now. So let's just take a look at what I'm talking about here. And let's just say that it's a nice round number. We like round numbers around here. So let's just take the 775 calls that expire in about 2 months' time. And those are less than $11. All right? So you're risking effectively, we'll call it 11. I'm going to use 11 and 765. That gets you to less than 1.5% of the current share price for SPY in this case. That's what I'm using. With an upside break-even of, we'll call it 786. Upside break-even is less than 3% higher in 2 months. And if September and October tend to be months that have greater volatility, and it certainly has proven to be the case in the past that they have been the more volatile months, and you're anxious about deploying capital, but there's also that fear of missing out element. When you get those additional paychecks and you're putting a little bit more to work in your account and you're thinking, are we going to get to those new highs? So for example, Tom Lee of Fundstrat, I think his target for the year is for us to hit 8,000. If we are to get there, what might be a decent way to play it? Buy some cheap calls. I don't think that there's really anything wrong with that here. And I would argue, given everything else that's going on, that might be the way to play it. And here's another thing that I saw over the weekend. Some of you may have seen this too, which I thought was kind of interesting. So, by way of contrast, let's take a look at the 10-year. So, Besant tried to do the Treasury twist. And when he did the Treasury twist, what he was hoping for was that he could get these long rates down. And they are effectively very close to the highs that they've been in the post-GFC era. So we'll go back 20 years and take a look. You can see that we're not far off of those highs. So we'll get over here, as you can see. This is what he looks at. If you listen to people like Jeffrey Gundlach, I do. I think very smart guy. He has concerns that there could continue to be some upward pressure on rates. The Treasury twist maneuver depressed these rates for about a day, then they bounced back. They're probably 3 basis points off of the close from last Friday. But there are people who are making very different bets. And one of the things we saw when they initially announced the Treasury twist and rates did fall, risk assets all rallied. That makes sense. So we saw a big bump up in gold. Stocks got a boost. Some real estate stuff got a boost. Crypto clearly got a big boost. And now we find ourselves in a situation where, you know, there are, of course, two sides to every market. Let me show you that some folks are making a very big bet that rates could probably stabilize here. This is an example right here. Fisher Investments, right at the top of the list. Nearly 161 million shares of IEF. That's the 7 to 10 year U.S. Treasuries. And that is about $15 billion worth. So there's really what would be the two potential ideas that they have and why they're positioned this way? Well, one is that they could say maybe they believe that, 4.7% is a decent risk-adjusted rate of return. Risk-adjusted not for things like default, but risk-adjusted for potential rate and inflation volatility. Or another thing they could think is that perhaps the Treasury policy will be backed up by Fed policy that will help keep a lid on the long end of the curve, in which case you should buy this. Now, this could have two potential drivers. One could be reduced inflation, which I have a hard time seeing where that's going to come into the picture. But if it was, and that was a fair rate, then that suggests higher growth, lower inflation. That's good for equities. That's one way to think about it. The other is that we're going to have slower growth, and that's not so good for equities, of course. But either way, I still think that based on this set of curves, the way I would be inclined to press bullish bets going into the end of the year in equities would be by buying upside calls. These are pretty much the cheapest options on the board, as you can see. If you picked out a higher volatility name, we'll put in like, Oracle is going to have a higher volatility, as you can see. Oops, why is it going to non-US stocks by default? Don't like that. There we are. So you can see just how steep those options would be. This is interesting too. Notice that this is positively skewed in Oracle. I don't necessarily think that should be the case. My rationale there is that Oracle has been taking on debt. As companies take on debt, the balance sheet becomes more levered. Equity becomes more volatile. The lower the stock price goes, the more volatile the equity should be, because a greater proportion of the company's enterprise value is in fact the debt. So that little piece of equity is going to end up having much higher volatility. So that skew does not look steep enough to my eye in Oracle because of that leverage aspect. Same way as I've often described, the equity in a house that has no mortgage will never be in percentage terms as volatile as the equity on a house that's got a 90% loan to value, right? So anyway, we have that. Okay, so with all of that out of the way, let me see. I'm going to try to perhaps take some of your questions. I've also reorganized my screens here a little bit. So let's do this. Oh, if I can. So let's see what we have. All right. Oh, no comments. Well, that's unusual, but that makes my job a little bit easier. Oh, Southpaw says, prefer SPY over SPX on that trade, I'm assuming due to cost. So this is, I'm really glad you asked that question. Why am I glad you asked that question? Because I actually generally prefer SPX options or NDX. I prefer SPX to SPY, NDX to Qs. And the reason I prefer it is because they're European and they're cash settled. So from an institutional point of view, it's just a lot easier to manage when you're just managing to the P&L and not managing to, you know, the risk that that you might get an early assignment, or that you should be exercising early, or that you either exercise an option or you are assigned and you have a resulting position in the underlying. So let's just take a look at the difference. I think more people are going to use SPY at a self-directed retail level than they will SPX. And that's probably just due to the premium. You know, the notional amount for a single SPX options contract is going to be 100 times the value of the index. So if the index is 7650, then that's $765,000 per contract, right? So SPY is going to be about 10% of that. But here's one way to think about the price of these options and the way we probably should think about them, because you may find that the SPX options are well suited to the size of your portfolio, and if they are, then I would encourage you to use them. Both SPY and SPX do get favorable tax treatment. So the long and short-term capital gains mix there is going to be a little bit better for index-related products than it can be in the single stock space. So, you know, that mixed straddle stuff will work for you either way. But let's just compare comparable moneyness. I think that's probably the best way to think about it. So we'll go out 1 month and we'll pick an option in SPX of comparable moneyness. Let's just say 5% out of the money, right? So we'll go out 1 month, and today is the 24th, so we'll go out to September 24th. There we are. Okay. Our forward is pretty much right there, but we're going to call it 76.53 spot 51. So 76.53 spot 76, and we'll choose a 2.5% out of the money call. How's that? Which is going to be 78.45. So 78.45. We've got the 78.50s. That's right there. And mid-market on these, we'll call it about 35.25. Hopefully that seems reasonable to everybody. So 35.25 over the forward, which I had in my head, 76.53 spot 76. Okay. And that takes us to 46 basis points of spot. Okay, so keep that firmly in mind. And now we can do the same exercise right here. So we'll go out to, in this case, it's going to be September 25th because I don't have a 24th expiration. And this one does have a dividend due, so the forward here, we got 764 or thereabouts. Is that what we're looking at? Well, I didn't quite see that. I'm going to have to shrink this down a bit. 765. at 785. So 785, I know that strike should exist. 785 does exist, and that's about 310, 307. So it's going to cost, this one's a little bit more. Not sure if I did the exactly right, because that should be pretty much the same percentage cost as the SPX options, because they're going to be the same volatility. Otherwise, there would be an arbitrage, right? So effectively, if SPY options cost more than SPX options as a percentage of the underlying, then you could sell the SPY to buy SPX, because the two are going to track very much together. And so you're going to find that the percentages are very, very close. So it was 30 some odd dollars to buy that out of the money, that much percentage out of the money call on SPX, and it's $3 and change, or about a tenth, to buy the SPY option, right? So what you can see is that the difference is, it's basically the same. The SPY options, the call options are American, and you do have a dividend, so there is a slight benefit if you're going to be long a call option, assuming that you're going to stay on top of it and say, okay, well, if it does go well into the money and it becomes optimal to exercise my call option early to get that dividend, I can do that. But I kind of like that element should also be priced in. And so I just like the ease of use that comes with European options and cash settlement. Also, I will just give a little bit of a story here, because I think it matters. And that is that one of the biggest trade-related issues or errors that I ever encountered was related to an inadvertent assignment on a reasonably large ETF trade. It was many years ago. It was coming out of the GFC. It was in IWM, was the underlying ETF in question. We were trading a lot of these very cheap call options in IWM. It was actually on a kind of a similar thesis to what we have here. The options were cheap, better way to make a bullish bet. That was not being affected by me. It was some customer of the firm that was trading these things and trading a lot of them. I think they bought something like 50,000 calls in a single trade. And of the 50,000 calls that traded, 6,850, for reasons that escape me, didn't clear properly. And they sort of went into the ether. And these options were not expensive when they were purchased. I want to say that these things were trading in the high single cent range. 7 cents, 8 cents, something like that. But the total amount of premium involved was tiny. Let's just say it was 7.5 cents. So $7.50 times 6,850 contracts. So it was $50,000 in round numbers. So nobody was really paying attention to it. IWM rallied, closed above the strike, and those calls auto-exercised because they were more than a penny in the money. So now it was not 6,850 7.5 cent options. Now it was 685,000 shares of IWM. And IWM was really whipping around. And I'm not going to mention the bank. People who have dealt with some of the bigger banks will probably be able to guess which one I'm referring to here. But their clearing operations were a bit of a mess. They were relocating a lot of people to Florida. They were hiring people that didn't have a lot of experience in this. And they let this trade hang out there for several days. In fact, actually, it was about 10 days before everything really came to a head. At one point, I think they were up $7.5 million on the long ETF position. And it wasn't until they were down 5 that somebody started to notice. So think about that. That's within a week's time or thereabouts. It was a $12 million swing on buying calls that only cost $50,000 to begin with. That was supposed to be the max loss. Kind of an important point. When everyone says, oh, when you buy an option, the most you can lose is the premium spent. That's true unless it converts into the underlying. And now you've got a whole different type of risk. In any case, that whole situation ended up really being quite a painful exercise because that bank, there was a lot of finger pointing and blame game going on. How they did not resolve the clearing problem, I will not know. They hoped we would help them out. Needless to say, we did not volunteer to. Why would we ever do that? And in fact, when they didn't know where the trade was supposed to go, under the rules, you're supposed to actually resolve all breaks on T+1. They didn't do that. Certainly not by T+10 or 11. So, anyway. Okay. Let's see here. Zawasi Ken, love the channel. What do you think about selling short puts on AMD heading into the NVIDIA earnings print this Wednesday after the trading session? So, I will say that I prefer not to be short options going into potential catalysts. I would much rather sell premium when I don't see something that's really obviously a good setup to move markets materially. In fairness, AMD and NVIDIA are not the same stock, but I think it's reasonable to suspect that if NVIDIA moves very, very sharply, it's probably going to take a lot of the other names in the space along for a ride with it. Why don't we take a look first and foremost at how these two track together. There we go. And it doesn't look like it's too much, but this is just, we're going to regress these things over the course of the last year or so. So this is sort of the relationship between NVIDIA and AMD, as we can see it here. Unsurprisingly, NVIDIA's kind of been left behind by some of the higher performing stocks so far this year. AMD would certainly be in that list. Micron's in that list. I was actually looking at Micron, SanDisk, Western Digital, and a bunch of those names over the weekend because I was interested, number one, in how well they've done this year. All three of those stocks are up triple digits. But also how much those stocks have fallen since their mid-June highs. And in the case of Micron and SanDisk, they're down 20+% off the June highs. And Western Digital's down about 40 off of its highs. So some pretty big moves in there. My preference would be to wait until the news comes out as far as selling puts. Because I think NVIDIA does have the capacity to move the market pretty materially and everything else in the space. That's my take. But really what I'm looking at is a preference to be in short options positions that at this point have a relatively low probability of assignment on the short side, while buying options that have a reasonably good percentage of going in the money on the long side, hence something like SPY. So making a bet, for example, that SPY could move less than 3% over the course of the next 60 days, that doesn't feel like a really big stretch to me, given the volatility that months like September and October have seen. And here's the thing, right? So if you're risking 1.4% of the underlying price to make a bet like that, then really, whether it goes 3 or 4% higher or lower, you're better off for having traded options to do that. And I would just try to avoid any really big obvious catalysts. I guess one of the challenges with that, in fairness, is that it's hard to know when you're going to have no catalyst, because we've got, it's not necessarily related to AMD, but just as an aside, in addition to the nonsense going on with the long end of the curve and whether or not the Treasury is going to be able to do something to manipulate rates out there, we've got this trade war tariff dispute with Canada, which is kind of a mess and rather ugly. And I kind of feel that Carney doesn't have much reason. I mean, I'm not in the guy's ear. I have no idea who's advising him. But you would think that if your adversary across the negotiating table is coming up against an important catalyst, such as the midterms, which the current administration presumably is going to be concerned about, then that does give Carney a little bit of operating leverage. I would also say that obviously with respect to what's going on in the Middle East, they're escalating this economic war with Iran. And while I think that has, the potential to be very painful for the people of Iran, I've seen very little, in prior negotiations with the Iranians that the folks in their government really care that much about their own people. And I also suspect that they aren't going to bow to that kind of pressure. So that's Middle East continues to be a little bit of a powder keg, excuse me. We obviously have the NVDA earnings coming up. We've got an FOMC rate decision coming up in September while we still have above target inflation. So there's a lot of things that could potentially create some noise. But I will offer the following, which is that in general, I like where your head's at, which is to say that if you are going to sell anything, I would prefer that you are selling options on single stocks, especially if it's going to be in and around and at the money, right? So consistent with all the things I've already said, so buying calls and SPY to make your long bets. If you are going to sell puts in single stock, then put spreads would be the way to hedge that to the downside if you're going to use index, just due to that steeper skew that I was talking about before, because you don't want to go out and buy 10% out of the money options in SPY and sell 10% out of the money options in single stock, because that relationship, that spread, that implied correlation benefit, it's a path-dependent issue. And if you follow that path, down 10%, it's not as compelling a trade as it is at spot. Okay. What do you think of an OCT 16 72.5 strike call in MCHP? I saw this trade on Options Action today. So that was maybe Oliver Rennick was talking about that. Let's have a look. Whoops. If this thing works, let's go have a look and see what traded. So, let's see what happened in here. Whoa. Is that right? Those are some big trades. Well, it definitely looks like this is a roll, right? So there was 119,200 open interest in the D65 calls and 119,000 trade. And now we're looking out to October 26, 72.5. Let's see. I wonder when were those put on? So that is interesting. Let's take a look at that trade and how they did. Well, if they were buyers of those call options, it doesn't look like they made much money. They may have been up money, but it does not look like they made any. So I'm curious what Oliver Rennick had to say. Was he suggesting that they bought the OX 75s? Or 70, was it the 72.5s? I see that's what you're saying. Yeah, 72.5s, okay. And that implied volatility is higher, so that makes sense. Well, let's take a look at what they paid in vol space for these. About 48. And the volatility realized, So I'm going to put the realized volatility up here, is much higher than that. So, okay, so far so good. That seems like a reasonable. If you have something that's trading at 60 vol and you can buy options on it for 45, that's a pretty attractive trade-off, right? So when realized volatility is as high or higher than the implied volatility you're paying for an option, that suggests that win or lose on the directional side, you're getting a good price on the option. So the optionality you get by purchasing the option is being had at a reasonable level. I would argue that it is a very reasonable level here. Let's look a little more. We don't have any obvious catalysts on the horizon. And so today, that's interesting. Today's the dividend X date. No? So why would those... So let me just go into something really quickly here. If you have options that are in the money and a stock is about to pay a dividend, how do you know whether you need to exercise those calls early? And the answer is, if the net present value of the dividends you would receive if you exercise the calls and own the stock exceeds the value of the optionality of that strike and expiration, then you should exercise the call option. How do you determine that? You compare the value of the dividend, which in Microchip's case is 45 cents, so it's material, right, to the value of the corresponding put. So now these were December options, but let's just say for the sake of argument that they were near-dated options, right? So we'll go to, let's just take a look at, I don't know, the September 4th expiration. So next week we're going to look at them. The 65 puts, as you can see over here, those are worth somewhere between a nickel, that's where they're bid, and 30 cents, that's where they're offered. Let's say they're worth 20 cents. So if you had the September 4th 65 calls last Friday, the last thing you should have done before you turned your machines off and went home for the weekend was notify your broker that you wanted to exercise those calls. Because by exercising those calls, you would get the stock and receive the 45-cent dividend, and the 45-cent dividend exceeds the value of the optionality on the strike of that expiration, which in this case we figured is about 20 cents. So that's 25 cents per share. That's going to be $25 per contract. Okay. Now, in this case, what's interesting, and this is quite unusual, is that you are seeing a whole bunch of options trading on the ex-dividend date. Ex-dividend means the stock's trading excluding the dividend today. So nobody's, doing anything with the calls, because normally what happens is you'll see a lot of volume trading on the day immediately prior as dealers try to get short the in-the-money strikes that have a lot of open interest that should be exercised. And what they're doing is they are hoping that people don't know they're supposed to exercise those calls early and forget to do so. And they will exercise all the calls they have. They hope they get away with some that retail does not. And every single time that they don't, they are going to get, something up to the value of the dividend for free, effectively. This was a trade we did quite commonly in high dividend paying stocks. So I made a market, I was one of the market makers in Philip Morris, for example, back when it was a single listed product on the MX. And this was a very common thing for us to do on the day before ex-div. We would just trade, 5,000 call spreads back and forth with each other, exercise all the longs, hope we got away with the shorts, and like that. This is unusual because all of this volume, all this call volume, is actually taking place on the ex-dividend date. So it was not for the dividend per se that this took place. because it's no longer in play. The next dividend is going to be in November. But yes, the short version is, and I wanted to bring that up just because, if you're looking at that and saying, oh, was this dividend related because it's the ex-dividend date? Not in that way. But if you know enough to at least pay attention to unusual options volume in and around an ex-dividend date, good on you. But that was not what this was for. I will say that the implied volatility suggests that the 72.5 calls are very reasonably priced. Okay. NVDA closed around 2.25, Monday 17th. Thoughts on Broadcom, September 11th, 360 long calls, quarterly earnings 9.2. Thanks in advance. Okay, Bob, let's take a look at that. So, what we're going to do here is take a look at the moves that we have typically seen in Broadcom, in and around earnings. This is September 11th. We're on the 24th, so we're a couple weeks away. Why don't I just say, let's see. Yeah, I'll go to, that's going to be 7. Now, this one won't allow me to go. The way the Bloomberg works, I can't actually make it. It only allows a 20-day window. So, but what I'm going to do here is I'm going to make it exactly that. So we're going to go to -13 to +7. Average move is 10%. And let's see where those options, and the implied move 6. Is that true? That sounds fishy, but maybe. September 11th expiration. 360 straddle. 17.5, 17.5. So we'll call it $35. That's 10%. So almost dead on fair value by the work we just did, right? So we figured out that it averages about 10% move over like periods of time. And what is the straddle priced at? Almost exactly 10%. So to me, that looks very fairly priced. So I would not be a seller of those options. All else equal, it looks like being a buyer is fine. I mean, if it's going to be trading right at fair value, I'd rather own convexity than be short it. Technically, the setup is a little weak here. And this is not surprising because of this rotation we've been seeing. Information technology has been getting a little beaten up. But, yeah, I mean, if you're inclined to make a bullish bet on Broadcom, buying those calls is very reasonable. They're priced fairly, and the technical setup is such that I wouldn't want to buy the stock here. I've kind of been making this point in general when I've shown this relative rotation graph, that technology that's over here has definitely been weakening. And we can see that in the technicals for these individual stocks as well. These are the best performing technical indicators for Broadcom. It hasn't been great. But that also, by the way, is one of the reasons why I think those SPY calls are not a bad idea. There's a lot of negative sentiment in some of the stocks that have been the best performing over the last year plus. And if we start getting some good results, I mean, that's going to lift the market like crazy. So, yes, you could certainly, spend 5% to buy an at-the-money call in Broadcom that expires on September 11th. That's about what it costs. Or you could spend 1.4, 1.5% on an out-of-the-money call option that expires in 2 months on SPY. And here's the question. If NVIDIA does well, if Broadcom does well, what do you think is going to happen to the market, right? To me, that just seems like a better... I kind of like that just in general a little bit better as the way to play it. But, if you're already in this trade, Bob, this is very fairly priced. All right. Bunny, can SPX diagonal call or put 3 months apart work to collect front month premium? Well, sure. it can. You know what? I'm gonna create two diagonals actually. Let's look at this, and let's look at a specific catalyst because this might be kind of interesting. So what I'm gonna do, and you know what? I'm gonna use the single stock land to illustrate this first. So we have Broadcom earnings. Why don't we start with that one? So one way that some people will make a play to try to collect a little bit of short-term options premium going into an elevated volatility regime is by doing a strangle swap, or people could call them a double calendar. In this case, we'll just construct it as a double diagonal, something like that. And what we're going to be doing here is we're going to be buying longer dated options and selling nearer dated ones. So we're going to buy, let's say we'll buy a downside put. Maybe we'll use a 20 delta. And we'll buy a longer dated call, also about 20 delta, let's say. Round numbers. And then we're going to sell a nearer dated call and put. And in this case, because we were just looking at September, I'll do that. And I'm going to, again, choose similar strikes. Did I put a call there? Yeah, okay. So maybe I'll make it 20 deltas again. Choose that. And 20 delta put. And that. So you get this kind of an arrangement, right? You've defined your risk because you are, just laying out premium. In this case, it's $1,000, which is not an inconsequential amount of premium to spend, but maybe it is when you consider that that's 3 shares of Broadcom, right? And the logic is that you're going to create, you're going to collect money. You have a high probability of profit in this trade, nearly 80%, and you have a break even that runs from down to 310 to as high as 421. And of course, you could do a similar trade in SPX or SPY if you wanted to. Now, one of the reasons people like to do trades like this in a situation like Broadcom is because you have identified a catalyst, and you know that because of that catalyst, the near dated options premiums are going to be elevated. So when you are doing a trade like that, what you're really trying to capture is this element right here, which is that these shorter dated options are trading at a premium. Of course, the flip side to that is they have a reason to. You have earnings coming out. Earnings can move stocks. Typically, they're more volatile during that period. So something like double diagonal, strangle swap, whatever you want to call it, what you're trying to do is find a way to mitigate the risk of selling premium. Because really, where the juice in this trade is for the people that are putting it on is in selling options. That's what they're really hoping to capture, is a more aggressive volatility crush and accelerated decay in the near-dated options after the catalyst comes and goes. So can you do that in an index? Of course you can. The issue that you face, though, is this. And that is that normally the term structure is going to be upward sloping, as it is here. And so selling those shorter dated options doesn't collect a whole bunch. I mean, I was saying, maybe you even buy these options, right? October regular way. I said that's probably a better way to make your bullish bets. So it's hard for me to encourage anyone to start selling index vol going into September and October with all of those potential catalysts that I just identified. And maybe even in here. Notice that you got the midterms in here. You got a little hitch in the term structure because that's also a potential catalyst. I would rather just own these options. That's just me. I just don't think you're getting paid a whole lot to be short, especially the upside options in index land at the moment. At the money and upside. So between 100% moneyness and call it 120 107% moneyness in index. I don't see a lot of juice in selling the upside premium there. I'd rather be a buyer. If you're going to sell anything in index land, it's probably the lower strike puts down 10% that have a little bit more juice. And if you do that, I hope you have some setup elsewhere that's helping to justify that trade. So that's my 2 cents on that one. Okay. Here we are. Blake, are retail traders missing opportunities if expecting seasonal declines in September, and how do I tack to a better course? Well, I think it is the pattern that people who are trying to time the markets will more often than not leave some money on the table. This stands to reason because there's frictions simply to trading at all. Sometimes those frictions are small. Commissions have shrunk considerably, so that's not a huge friction, but it's still in there. And if you're saying, no, my broker doesn't charge me any commissions, well, there are, of course, transaction fees. You just don't see them. So if there's payment for order flow, for example, there is a commission of sorts that's getting paid to the executing broker. It's just coming from the market making side. So that friction still exists. Bid-ask spread is in many cases very tight, but it still exists. And then, of course, there's also tax implications. You don't see that straight away, but those two exist. So when you put all of those things together, you're just adding little bits of friction, little bits of slippage every single time you transact. And so if you imagine all the buyers and all the sellers out there, even if they were just flipping a coin and it was a 50-50 shot, net of those things, they're probably going to lose. So if pressed, I'm always going to deter people from affecting transactions unnecessarily. That said, I do think that there are regimes that have better setups from a risk-reward perspective than other setups might have. I already outlined one of them, which is that if you're going to be long here, I think index options and ETF options on those same indices are cheap enough that that's just a better way to play it. You're risking a little, could potentially make a lot. That's usually a pretty good setup. And there still is a volatility risk premium in the single stocks, so I still like overwriting single stocks where the volatilities are a little bit higher, especially those ones that don't have any immediate upcoming catalysts. And if you think about it this way, if you're generally long stocks, and most investors are, you're collecting a bit of premium because you're selling off some upside calls or call spreads, you could take a small portion of that and throw that money at some index calls. And if we get one of those really big months, you can get meaningful participation. And, because you can have upside correlation as well as downside correlation. So from my perspective, that's definitely the way I would prefer to do it. The other, and this is another thing, have a core position. I speak to a lot of people, who should know better, who they pivot wildly on the bulk of their portfolio, rather than having a core sort of long-term portfolio and then trading around that. Unless you are a professional trader, and I'm a professional trader, right? So I am paid to move money around each and every day. I did so today. Probably did 40, I don't know, I'll pull it up on another screen. I'm not sure how many options trades I did today, but I think it was about 40. How many contracts we traded, but that's a very different thing, right? If you're not getting paid to do it, then you probably want only to do it when there's a really compelling reason to do so. What do we have here? Yeah. What did I say, 40? Well, it felt like 40. It was 34. 34 trades. So I guess it felt like more because a lot of them stacked up on me all at once. But Yeah, I mean, I think 80%, 80-20 is kind of the rule I would think you want to work with. You know, 80% of your positions kind of core, long term, and then you know the rest of this stuff. There's another reason for this too, and that is that one of the things I've also observed for people who are self-directed investors who end up trading options, and they go into more of an 80-20 mix where they're punting it around with 80% of their capital, and 20% is really their sort of core holdings, is that they end up being the weak hands. I see those folks getting, you know, undone essentially when the market starts to really work against them. They panic and blow it out, and that's partially because they're just taking too much risk. So you know, if you can't settle down and you know say, okay, let's really sort of, to pardon the pun, take stock here, you know, then you're just taking on too much risk. So I would encourage core holdings for the bulk of it, and then you know 20-25% maybe outside of that. Okay, let's see what else we got here. Kirk purchased the 237.5 August 28th and sold the 215 puts, expecting a move up from the August 17th close. Sold. When did you sell the 215 puts? Aren't the 215s in the money? I'm assuming you're talking about NVIDIA, yeah? Yeah. Where were we? Let's see where we are. Yeah, 208s. Okay. Well, that trade probably, I mean, you know what? Let's take a look so everyone can sort of get a sense of what that looks like. So let's just show what that trade, you know, you only trade from settlement. So what matters right now is what the P&L looks like going forward. So we're going to just go back. You've got pretty short dated trade on here. So you are long the 237.5 calls, and you are short the 215 puts, and you end up with a trade that looks like this. Which, you know, the interesting thing is, this is not dissimilar to the position that we have on in our INVIT and NVIDIA books. So I'm actually curious to see which. Might as well just double check that. Why don't we just have a quick peek here? So we are in. Oh, look at that. Okay, so we're on the 232.5s on the long side, and the 227.5s, and we're short the 222.5s. So we're in a very similar position to what you have. So I hope your trade wins, because if yours does well, then ours is likely to do well too. That fund's got about 1.35 billion in it, so I really hope, really hope you're right. That would be nice. That would be very nice. Richie Rich, can you distill your 3 favorite option strategies based on current projected market conditions? Projected by whom? So, yeah, let's talk about that. I think I've kind of, I mean, I hate to beat the dead horse here, but at the moment, in general, well, let's just talk what I'd like to be long and short, sector-wise. So sector-wise, I like materials. I like healthcare. And I have to say that on a sector basis, I'm cautiously optimistic about technology, but I wouldn't be adding to it here. And instead, as I just alluded, knowing that it's 47% of the S&P, and options on the S&P are cheap. So if I'm hoping that Tom Lee is right, and I am, then the best way to play that is to be long upside index calls in SPY. And to the extent that you have positions in some of these other areas, maybe long stocks, selling some upside calls or call spreads against that, because those premiums, that differential is very great. And we see that when we look at, this is when I talk about the correlation. This relationship right here. So this is 50 delta, right? And it looks like it's popped up a little bit today. But this is fairly low, as you can see, right? I realize this looks really noisy. Let me make this quarterly so we don't have to. Doesn't have to be quite so noisy, right? But this is what we're talking about, which is what is the relationship between prices on different securities, and you try to find places where options are cheap and where they are, if not expensive, more expensive. Buy the ones that are cheap or cheaper, sell the ones that are expensive or pricier. Lean long, because inflation, economic growth, and the free markets are generally going to act as a tailwind over the course of time. And that's basically it in a nutshell. And what the only thing that really differs is which sectors are exhibiting strength at any moment in time. So this is really my philosophy in general, which is that you stick with what is working. You lean long in the markets. And as I've previously discussed on many of these, I don't like to buy things that are below their long-term moving average. No matter how I feel about them fundamentally, when I screen, it just doesn't come up, because things that are cheap can get a lot cheaper. And I don't know exactly when something becomes so overpriced that it has to go lower. So even if there's something I liked at a level and now the valuation's getting a little more dubious or not as compelling as it once was, that doesn't necessarily mean that I'm going to start selling it, because there are a lot of points in time when one could have sold many of the stocks that have been the best performing over the course of the last 3 years, because you said, well, this has got to end. I'm sure it will. They always do. But I've never top ticked anything, so I'm more inclined to sell stuff when it starts to roll over. I really, one of the things that I think is important is that also institutional investors, we're institutional investors. We also, we're not paid to keep people's money in cash. I've said this once or twice. So we really have to find the best place to deploy capital that we can. And sometimes you see things that look really good. Sometimes you find that things just simply look okay, all else equal. But okay is good enough. The only time you bail out and really start increasing your cash is when it's 100% not okay. Because that's, our job is to deploy capital. And from an institutional point of view, we're more limited sometimes than retail market participants are, because what you can do is you could say, okay, well, I'm going to deploy more capital by just simply buying upside calls and SPY. In equity funds that we hold, that's not part of the mandate. That's not inside the prospectus. That isn't one of the things that we can do. So I'm sitting here saying I think it's something that one should do, even though I might not be doing that in anything that we're doing, because we can't just go out and buy SPY calls. I can't simply say, I'd much rather be long SPY calls going from now until the end of the year than long $2 billion worth of NVIDIA, because I think the risk-reward relationship is better. But I do think that the risk-reward relationship all else equal, is very favorable in SPY and SPX if you're going to make a bullish bet. Buy calls. I think they're not expensive here. And if the market has a meaningful pullback, 7.5%, that would be meaningful. 10% is a formal correction, so of course that's meaningful. You'll be glad you did. And you can reload. So those are all things that I like. There is another trade that I have also mentioned that I like a lot, and this is something you guys can do, and that is that oftentimes as a hedge, I will also, if I'm short premium in a lot of single stock, buy a strangle, 20 delta strangle out 30 days in the S&P and hedge it each day. So, if the S&P falls, I'll just true it up with SPY. So I'll own SPX, and I'm sure that most of your brokers will cross margin between SPY and SPX. So that is to say that whatever deltas you accrue in your SPX position, your broker is going to cross margin that if you have a customer portfolio margin account with your SPY deltas. And so the margin requirements to have that trade on are really small. And again, this kind of goes to that peace of mind thing, which is that when you have positions like this, you can be pretty sanguine when things get woolly, because you got something that's paying you a little bit while other things are going sideways, and that's a good position to be in, to be able to take a step back when things really start to look wild and say, okay, what do we like here? I think that's also very important. Okay. Whoa, I have chewed up more than an hour already? I didn't even see that. This day has just been hustling along for me, I have to say. Our crack production staff will say that I was still buttoning my shirt with about 2 minutes to go, because I was sitting here and I spilled some of my lunch on the shirt I was wearing right before this. But in any case, I always appreciate your time and your questions and insights. I find them insightful as well. And, fingers crossed here, Kirk. You've got that trade on. We've got that trade on. NVIT. We're long the market, as we always are, on balance. We have some short positions too, but for the most part, we are overwhelmingly long the market. But for you guys, if you are thinking you want to be overwhelmingly long the market, you have an option that we do not, and that is upside calls and SPY, the Qs, NDX, and SPX. And as far as I'm concerned, that's the way to press any bullish bets that you're making from now until the end of the year. And I think that's a good place to leave it. So tune back in, like, subscribe, comments, always welcome. And we'll see you here Wednesday. Thanks for watching.